A big part of accounting is recording important information so that we can analyze it and report it to stakeholders later on. In a business, there are many types of important activities that happen every day, but which ones are worth recording in our accounting system and which ones should be recorded someplace else? The only activities we want to focus on are the activities that initiate the accounting process of recording them in an accounting system. We call these accounting transactions. There are 3 requirements for an activity to be considered an accounting transaction. First, the activity must be specific to the business. This means that the activity specifically involves the business in some way. If the activity only involves the owner, then it doesn't count. Remember that this is one of our GAAP rules we learned earlier. We need to keep the business activities and finances separate from the owners. That's the business entity concept. For example, if Jill, the owner, sells her old computer to someone else, that doesn't really affect the business at all, just the owner's finances. So that's not an accounting transaction. Now, if Jill's business bought that old computer, now the business is involved, so it is considered a business transaction because the business is part of the activity. The second requirement is that the activity must be measurable in monetary terms. Accounting is all about recording money and how it moves. So even if the business is involved, but there is no money or value for the business, the activity isn't an accounting transaction. For example, let's say that a customer loved Jill's service and left a 5-star review on Google. That's a great activity, and it may help her business earn money in the future, but there is no way to measure that 5-star review in terms of dollars. So that's not an accounting transaction. If someone else read that review and purchased $6,000 worth of services from Jill's business, that sale can be measured in dollars and it involves the business, so it is an accounting transaction. The third requirement is that the activity must impact the accounting equation in some way. In other words, the activity must make some part of the accounting equation increase or decrease. Everything in accounting flows through the accounting equation. That's why it's considered the foundation of accounting. So if your activity doesn't touch the accounting equation somewhere, it's not an accounting transaction. Let's imagine that a customer asked Jill for a quote for her business to perform $5,000 worth of work on their computer network. That activity involves Jill's business and can easily be measured in monetary terms, but it doesn't affect the accounting equation. A quote is just an example of costs. There is no obligation to do the work and no sale or expenses have taken place yet, so there is no place in the accounting equation where it fits. So this activity is still not an accounting transaction. If the customer likes the quote though and decides to purchase the services, now Jill can record that contract as a sale of services under the owner's equity section of the accounting equation. So that sale would be considered an accounting transaction. So just a quick recap. Accounting transactions are activities that initiate the accounting process of recording it into the company's accounting system. There are 3 requirements for an activity to be considered an accounting transaction. First, the activity must be specific to the business. Second, the activity must be measurable in monetary terms. And last, the activity must impact the accounting equation in some way. To learn more about accounting transactions and other accounting topics, check out more of my videos on YouTube or visit torinorman.com.